Good Saturday morning to everybody, and welcome to the Mortgage Matters radio show with Rob Weinberg. I'm Gary Byron. Rob, what's up? Good morning there, my friend.
Good morning. How are you, Gary?
You know, I got to tell you, I'm hanging in there over here, doing my best. How about yourself?
Doing well. Doing
I'm
doing
glad to
well.
hear that.
Very busy as usual.
I can imagine. This is the time. This is the time. I have a buddy of mine who's a real estate agent, and he's like, putting a house on the market, and then I'm getting calls within the same day that it's listed, and there's people who are making offers that exceed the asking price. So this is really a
very often
seller's market. Of course, if you're going to sell and then you're also going to buy, it's going to turn the tables on you very shortly thereafter. But if you're moving out of state, hey, that's that could be to your advantage. I'm sure you're hearing a lot of people who are looking to both refinance as well as looking at what the interest rates are.
Yes.
Hey, coming up at the end of the show, we're going to talk a little bit about HomeBot, right? There's a special offer that I know that you'd like to make to really offer your listeners here. We can go into the details of that and as far as what people need to do as far as emailing the show and so on and so forth. Can you give us maybe a little bit synopsis later on? What HomeBot is?
Yeah, absolutely. HomeBot is something I've been using with my private clients for almost 2 years. It's phenomenal. It tracks your home value. It tracks interest rates and different opportunities to refinance. And I would like to make it available to some people outside of my private client base.
Well, really? So, well, we'll get into that. All right. So let's talk about some interest rates. Maybe we'll start with something very kind of basic. I want to talk about some of the myths out there right now, misconceptions as well when it comes to interest rates.
Yeah, so there's a lot of misconceptions and a lot of myths, a lot of misinformation out there about interest rates. So let me touch on that. I would say the number one thing that people think when they hear the word interest rates is, I want the lowest rate no matter what. That's a really common theme.
Of course.
Right? Why wouldn't you?
Yeah, I was going to say, who's out there saying, give me the highest rate you can get me?
Well, you'll see why that isn't always the best move. So I'd say that's the number one misconception is I want the lowest rate no matter what. And the key is no matter what, because there's some tricks, there's some scams, there's some manipulations that mortgage companies and banks use to make you think you're getting the best deal and the lowest rate when you're actually not really getting as good of a deal as you think. Again, we'll touch on that here in a little bit. The next thing is along those lines is the lowest rate is always the best rate. That's a myth. That's a misconception. The lowest rate is not always the best rate. A competitive rate with the right strategy is better than the lowest rate on the wrong strategy or the wrong product. And I'll give you an example of that. A client that had come to me a couple years ago and said, I want the lowest rate no matter what. And they were, adamant that that's what they wanted. The 15-year rate is going to typically be the lowest rate in the market. So they went and took a 15-year mortgage at the time in the high 2% range. And I saw with their budget, with their finances, it was going to be a little bit of a stretch on their monthly nut. But again, they were absolutely convinced that no matter what it takes, I want that super low 15-year rate. Well, fast forward to COVID. And what ended up happening was their hours at their job got reduced significantly. They still had a job, but that 15-year mortgage they had taken a year earlier, it wasn't working for them anymore. They had this awesome rate. They were bragging to all their friends about this rate in the 2% range that they had, but then they got into a predicament where they weren't going to be able to make their mortgage payment. So that's an example of where it wasn't the best. But here's the long part of the story, which is they ended up needing to refinance. 1 year after they took that 15-year, they couldn't do it. They were either going to go late on the mortgage or they were going to have to get a new mortgage. So we had to take that 15-year loan they were 1 year into and stretch it back out to a 30-year loan. Obviously, the rate was a little higher, but their payment went down significantly. They were able to get through COVID. They were able to get through that time of their income being fluctuated. So in that case, the lowest interest rate wasn't the best. They either shouldn't have refinanced at all or they should have done a new 30-year mortgage with a higher rate. It would have dropped their payment. Because again, if you don't do it right the first time, you end up needing to do it twice.
Yeah, you end up being cash strapped. That's not a way to go through life. When you're cash strapped and something unforeseen comes down the road, and all of a sudden you're sitting there going, all of our money now is going to this mortgage. You're absolutely right. I can't imagine how their life was during that year to get to the point where they can.
Well, they felt good at the time.
At the time, yeah, when it was rainbows and unicorns. But
you always need to look at different scenarios, worst case scenarios, and like we've talked about before, for some people, depending on your job, depending on your savings, if you have 6 figures in savings, then maybe you can take an added risk of losing your job or having a reduction in income with a high mortgage like that. But if you are paycheck to paycheck, barely making ends meet, maybe you have 1 or 2 months of savings, taking a 15-year mortgage with a low rate, it can be, a really, really bad idea.
I'm just curious, Rob, what are the factors that go into determining an interest rate?
That's a great question. And a lot of people think that there's one rate. I have consumers call me and say, "What's your rate today?" As if it's like you're ordering off a menu and there's like one beef dish and one steak dish. That's not how interest rates work. There's a lot of different factors that go into that, and everybody is going to have a different rate. So let me talk to you about some of the main factors. We don't have time to cover them all, but let's talk about some of the main factors. Number 1, credit score. I think most people understand that the higher your credit score is, the lower your interest rate's going to be, generally speaking. So that's number 1. The next thing is a loan term, like we were just discussing. A 10-year or a 15-year mortgage is going to be a lower rate than a 30-year or a 20-year mortgage. The shorter the term is, like we've discussed, the higher the payment. There's less risk because you're paying the loan down quicker. So the loan term is a big factor in that. Next thing is going to be loan amount. If you are taking a mortgage for less than $100,000 with a lot of banks, you pay a higher rate. Why? Because there's not that much profit to be made on a really small mortgage. So a lot of lenders, credit unions, banks will penalize you on your interest rate depending on what your loan amount is. So the ones I've seen are if it's under $100,000. With some banks, if it's under $150,000, they will actually increase the interest rate on that. Some banks have the other way. They'll give you a better interest rate if it fits in a certain criteria, like 125 to 150. You can see now as these factors start adding up. And then the other side of the coin is a jumbo loan or a large mortgage, which some areas of Connecticut, there are people taking mortgages for $700,000, $800,000, or $1 million or more. Those mortgages typically have different interest rates than a conventional conforming mortgage with a normal loan amount, which would be something like, in most areas, less than $600,000, generally speaking, is considered a non-jumbo loan. Again, depending on your area, I'm just giving generalizations. The next thing is the loan program. Is it a government loan, like an FHA loan, is going to have a different interest rate than a VA loan or a USDA loan or a conventional mortgage like Fannie Mae or Freddie Mac? They're all going to have different rates. So you could go with the exact same scenario, same credit score, and all the factors the same, and get a different rate on an FHA loan than you're going to get on a conventional loan. Again, you're starting to see these factors come into play. The next thing is loan type, as far as fixed rate versus adjustable rate. Typically, as we'll discuss here further, the adjustable rate is normally going to be a lower interest rate than a fixed rate. Okay? So that's one factor there. And then purchase mortgage versus a refinance mortgage. I know my company has been running an incentive on purchase money mortgages with a 1/4 point off of the cost of the mortgage for purchase to help, again, incentivize. It's almost like, again, going to a restaurant or somewhere and they're running a promotion. Depending on what lender you're dealing with, they might be running an incentive or a promotion to take a purchase money mortgage versus a refinance. That's something that I've seen. And then along the lines of refinancing, there's really 2 types of refinancing. There's a rate and term refinance where you're just lowering the rate or changing the term, and then you've got a cash out refinance. Doesn't matter if you're consolidating debt, taking money to improve your property or invest in another property. Anything where you're liquidating equity out of the property is going to be considered a cash out refinance. Those are higher risk loans. You're taking money out of the house. That's going to have a higher interest rate than a no cash out refinance. Occupancy. Are you going to live in the house? If you're not going to live there, if it's a second home or an investment home that you're going to rent out, it's going to have a higher rate than a primary residence. The lowest risk, the lowest rate is always going to be the primary home, which is the house that you live in as your primary. And then we'll just touch on two last ones here because I know we're limited on time, which is debt to income ratio. What is your debt versus your income? And especially during COVID, I saw a lot of lenders that had penalized people on their interest rate if you had a high debt to income ratio, because of your higher risk. If you have, for example, more than a 50% debt to income ratio on an FHA loan, you can still get the loan in most cases, but it's a higher risk loan. You're really pushing those boundaries, so you're going to have to be compensating the investor for that. And I would say last but not least would be property type. Is it a condominium, a single family home, a multifamily home? Is it a 2-unit or a 4-unit? The single family home detached property is almost in every case going to be the lowest rate you can get. Condominiums do have higher interest rates, not a lot higher, but there is a hit in most cases to the interest rate. And then multifamily, again, like we've discussed on previous shows, you have other people paying you. There's tenants involved. That increases the risk. So a 2 to 4 unit property in most cases is going to carry a higher rate, in some cases a significantly higher rate than a single family home. And again, these are not all the factors, but these are the main ones that I want you to understand all of the things that go in, and that it's more than just saying, what's your rate today?
All right. So based on what you just said, two things come to mind. I have two questions. You talked about the jumbo, right? This is for over $600,000, right?
Depending on the area. In some areas in Fairfield County, it's, the limit is higher than that. In other areas like Hartford County, it's less.
Is it because it's going to require more money? Is that what makes a difference with the interest rate?
No, it's not because it requires more money from you. You're talking about income to pay.
No, I'm about borrowing.
Yeah, because there's a lot more at risk.
Right.
Somebody taking a mortgage for
$1 million,
let's say,
right, it's different than $1
million. If somebody doesn't pay the bank back $150,000, they're going to lose less than the guy that doesn't pay back $800,000 or $1 million. So there are definitely
But when you
factors.
scale it, you've got to be qualified for $1 million.
Of course.
So you have the money to pay it back.
It's
No
a
different
concentrated risk, though. Just like in real estate investing, do you want one property or do you want 3? If you have $1 million to lend out, what is higher risk, lending it to one person or lending it to 6 people?
All right, that makes sense. Then the other question I had was if you can just differentiate, between a variable rate and a fixed rate.
Sure. So the last few years especially, fixed rates have been all of the rage. There hasn't really been an incentive. But the way a fixed rate works is the principal and interest portion of that mortgage is the same for the entire duration of the loan. So if it's a 15-year loan or a 30-year loan, that principal and interest payment is never going to change. Obviously, if you include your property tax and that goes up, that part could change.
Right.
Or your home insurance increases, that part could change. But the P&I, which stands for principal and interest, will stay the exact same for the duration of the loan. That's why fixed rates are so attractive right now, because you can lock in a really low fixed rate and maybe you get a raise every year. So your income's going to go up, but your mortgage principal and interest is going to stay the same. Now, on an adjustable rate, most of the adjustable rates that are offered now are what I call hybrid programs. So what that means is that there's a fixed portion of that. Maybe it's the first 3 years, which is called a 3-1 arm or adjustable rate. Maybe it's fixed for the first 5 years. So you have this initial fixed period, and then after that, the rate typically adjusts, depending on the loan, every year is the most common. So if you do a 3-1 arm, you're going to get a low rate for the first 3 years, but then after, the rate has the potential to go up and
Do you recommend that? Who would want that, though?
People that want the lowest rate a lot of the time will want that, and they don't
understand it's only the lowest
risk.
rate initially, though.
It is, but the average homeowner refinances or sells their home every couple of years. I think the last time I checked, it's every 3.5 to 4 years.
Okay.
So if you knew that you were going to get a new mortgage within 5 years, then why not just lock in for 5 years, get a little bit of a lower rate? But lately, this hasn't been as popular as it was when I started in the mortgage industry back in the early 2000s. I would say 75% of people were taking these adjustable rates or these hybrid rates because they were so much lower. They were in some cases a half to a full point lower than a fixed rate. And because equity was growing so much and people understood that they were going to refinance or sell their house, they were taking these adjustable rates. The downside was when the housing market crashed, they couldn't refinance. They lost their job. These other things happened and they were stuck with this high mortgage. People remember that still now, and that's why I haven't even done an adjustable rate in probably a year and a half to 2 years.
Yeah.
Because the fixed rate is so attractive. If I told you I can give you a fixed rate at 3%, or I can give you a 5-year hybrid loan adjustable rate at 2.8%, well, why would you take the risky one when the fixed rate that's guaranteed is only a fraction of a percent higher? That's why the adjustable rates have not been in vogue like they had.
But if it was an adjustable at a full point less, let's say at 2%, all right, and that would be a lot more attractive, and then just refinance as you hit that 5-year mark.
That's the idea.
But were the lending institutions, were they catching on to this and saying, hey, we're giving you this great rate, we're getting the bad end of the stick here because you're not sticking with a
They're
longer...
not, because not everyone's going to be able to refinance, so
So they're taking that gamble then.
They're taking the gamble, but this product we're discussing here, these adjustable rates, generally speaking, are one of the main reasons for the housing crash back in the earlier part of the 2000s.
I remember
because people did these saying, oh, I'll just refinance in a couple years. Oh, it's fixed for 2 years. It's fixed for 5 years. I'm good. But then what ended up happening was the housing market crashed. They couldn't refinance because their home value had gone down, or they lost their job, or something changed. And now the bank's licking their chops because now that's what that's how the product is designed. They can then increase your rate in the future. You making the payment or not is your problem. Now, one thing I will give credit to the banks and the regulators for is to get an adjustable back then, they didn't factor in home values dropping. They didn't factor in the rate going up. Nowadays, to get an adjustable rate mortgage, the underwriter is going to look at, what does this look like 5 years out or 10 years out? How high could the rate go? And could you afford the house if the rate went up significantly? That's one piece that they're doing now that they didn't do before. And then the other thing is equity. You're not getting an adjustable rate if you're putting 3% down.
Yeah,
you're having to put a big down payment.
I'm just glad, I'm glad you clarified that, because I was thinking, if after 5, maybe they would make you sign a 10-year agreement where the first 5 was, low fix, and then it could be adjustable for the second 5. But it doesn't sound like they're holding your feet to the fire for,
Usually an adjustable rate's going to be a 30-year term. So if it's fixed for 5 years, it's 25 years where it'd be adjustable. Does anyone really keep it that long?
No,
Absolutely
no,
not.
Of course not. Folks, you're listening to Mortgage Matters radio show with Rob Weinberg. I'm Gary Byron. Let's talk about discount points. How are they used?
So discount points are really popular nowadays because everyone just wants that low rate. So discount points are prepaid interest. It's basically you as a homeowner or a home buyer going to the bank and saying, I'm going to prepay some of the interest. I'm going to pay a fee, which is called points, to lower that interest rate over the term of the loan. Now, 1 point is equal to 1% of the mortgage amount. So if you're borrowing $200,000 and you're paying 1 point, that's a $2,000 fee that's added onto your closing costs. If you're borrowing $200,000 and you're paying 2 points, that's $4,000 in fees, additional fees that you're paying. And people just look at the rate. And there's some big box lenders that I will remain unnamed on this broadcast here that are predatory, and they take advantage of people because they offer super low rates, 2.5%, 2.3. But if you read the fine print, it comes at a huge cost, 2 points or even 3 points that you have to pay to get that rate. And again, people are so fixated on this low rate that they don't realize that paying 2, 3, 6, I've even seen over $10,000 in discount points to get that lower rate. They would have been better off taking a higher rate and paying less points or no points. Most of my clients end up paying no points. That's something I take a lot of pride in because a lot of banks, again, manipulate and take advantage of people. I give a lot of my clients those options so they could see, hey, we can get your rate down by paying this much, but it's going to take you a certain amount of time to break even. That's the big thing that people miss.
So many people, Rob, people are fixated on these low interest rates, right? I mean, especially as being the deciding factor when it comes to making these decisions on their mortgage. They're not even considering these discount points or anything else for that matter.
No, and the reason that people are so fixated on interest rates being that deciding factor is because if you step back for a minute and think about who did you learn about finances from? Who did you learn about mortgages from? Your parents. Well, when you go back, who did your parents learn from? It's the banks. It goes back to the banks. The banks taught American consumers how to manage their money, how to manage their mortgages. They want you to get fixated on the interest rate so that they can manipulate and make money off you on all these other fees and all these other ways. And again, it just comes down to you're learning how to manage your money from the enemy, so to speak, from the person that's making money from you. That's why people are so fixated on this. But again, as we're discussing, the interest rate is not the most important thing.
Yeah, and that's why this show is so important. You're telling it as it is. People need to know this. And what other tricks that are being used to confuse consumers into thinking that they're getting a better deal than what they really are?
My answer on this is going to be really controversial because I am throwing some people under the bus. Some mortgage companies, some credit unions, some banks that do these things. I'm going to let the cat out of the bag here. I've been doing this almost 20 years. I've seen loan estimates from hundreds of banks all over the place and all different areas. And I'll tell you the top 3 or 4 scams that I come across, and I call them scams because they're manipulations to take advantage of people. Number one is that they'll offer you this super low rate and you feel like you're getting a good deal based on a phone conversation. You submit all your paperwork, then they go to lock in your rate. And when they lock that rate in, they add all these additional fees. They add all these extra points that we're talking about, and all you're looking at is, oh, well, they told me 2.875, and that's what it says on the paperwork, but you fail to realize that they're charging you 1, 2, or more discount points or extra fees in order to get that rate. Most consumers just feel like, hey, it's a good deal, let me sign. They don't really question it. The next thing is changing the rate at the time of the rate lock. So a lot of companies will advertise on billboards, TV, and radio about a super low rate. You'll contact them and they'll engage with you to get this mortgage. But then once you get them all your paperwork, all of a sudden the rate changes. Maybe it was 2.75, and then you go to lock in your rate a few days or a week later, and the loan officer tells you, oh, I'm sorry, the rates have gone up. I can't get you that 2.75 anymore. Now it's 2.99, or now it's 3.25. And again, you're already engaged in the process. A lot of people don't do further due diligence, and they just take that. Even though it may not be true, they just move forward. Next thing is that a lot of banks and lenders will charge additional fees, and they'll broadcast to you and they'll sell you on the fact that, hey, you're not paying any points, but they disguise it as another type of fee, maybe a loan processing fee or origination fee. So those same thousands of dollars we're talking about to buy the rate down, they will tell you, look, points says 0. You're not paying any points. But they bundle it in other fees. So it's really the same dollars, and it's just a psychological thing because people are taught, I don't want to pay points or pay as little as possible. So they show you it's no points, but they add it on other fees. They bundle it in other fees. The last one that I'll say, and this one I haven't seen happen that much lately, but back during the last housing crisis, it was really common for kickbacks. Kickbacks mean that somebody's getting a commission or an extra fee for putting you with a certain provider. So one thing that was common is a mortgage company would have a partnership with an attorney's office or a title company, and they would say, hey, send us all your clients. Every client you send us, we're going to give you $500 extra kickback on the back end. It's 100% illegal. You can lose your mortgage license and legal license for doing something like this. It's against the Real Estate Settlement Procedures Act, but back in the day, nobody was really looking at that. And even nowadays, there are some unscrupulous companies that will say, hey, we got you set up with a great attorney. We got you set up with a great title company to do your closing. Really what's going on is they have a backdoor relationship with that person. They're overcharging you on the attorney's fee. They're overcharging you on the settlement fees or title insurance and things of that nature. And then what's happening is they're taking that money and they're giving them a kickback on the back end.
How can someone tell, though? And you have all this knowledge. You're on the inside. This is your industry. But how can someone tell if they're getting a competitive interest rate when they're not getting ripped off on their mortgage?
Like we talked about, there's so many factors that go into an interest rate calculation. You can't just say, well, my neighbor's getting a 3%, so I should get a 3%. Where you should be looking is there's an average rate published every week by Freddie Mac. You can just go on Google and search Freddie Mac average interest rates. They will show you the average interest rates that people are getting all over the country. They will also show you how many points they're paying for that rate. Typically, the rate that you're going to see on there includes anywhere from a half to 1 point. So that can give you an idea if the offer that you're getting is at least in the market. Now, if you have a low credit score, a more complicated scenario like an investment property, a second home, a low down payment, all these other things, your rate might be higher, but you can at least see the trend for owner-occupied, single-family, just vanilla loans. The other thing that I have all my clients going with is HomeBot, like I said, to get them in on HomeBot, to show them on a monthly basis, here's the going rate, here's how much you can save.
All right, so you brought up HomeBot. Let's talk a little bit about that because from what I understand, I mean, this is really not available to the average consumer, right? You've got to be on the inside.
It's
Somebody
not.
like yourself.
You have to
right?
get sponsored by a mortgage lender or a realtor in order to get a HomeBot report. You cannot get it as a consumer. It's something that I've been offering to my private level clients, like I said, for almost 2 years, and there's so much value in a HomeBot report. It's a monthly report that goes to your email. You don't have to speak to anyone or provide any personal info, and it will look at the trends of not only mortgage interest rates, but also the home value. It'll show you a graph of the value of your home.
Oh.
You can tune that value if you've done home improvements, if you've added a kitchen or redone this or that, you can tune that value to get it as accurate as possible, and then it will track that value over time to alert you. What opportunities do you have to save money on refinancing? What's the going interest rate on a 15-year loan, a 30-year loan, etc.? How much would you save theoretically?
Now, in order to get this, you've got to be your client traditionally, right? That's how you offer this. However, if you folks right now, by listening to the show, if you're one of the first 5 people to email Mortgage Matters Radio Show at gmail.com, you will get this absolutely free. But you got to email and be one of the first 5, so I wouldn't wait. Email right now, Mortgage Matters Radio Show at gmail.com, and you'll get this HomeBot report.
You'll just want to provide your property address to me with your name and your phone number so I can load you in, and then you'll get an immediate email once I put you in the system.
If you want to check out Rob's website, it's www.robgw.com. Again, it's real easy, robgw.com. And if you would like to contact Rob Weinberg personally, all you got to do is call him, 860-413-3938. Once again, 860-413-3938. For Rob Weinberg, Mortgage Matters, I'm Gary Byron.